turning our attention to Cannon. Since 1996, Cannon Asset Managers investment team has conducted the Superdogs study, which embodies the core principles of deep value investing. The fund has been running with outside capital for now 3 years, celebrating its 3rd birthday in June. To talk more about Superdogs and the portfolio, we're joined by Adrian Saville. He's the Chief Investment Officer at Cannon Asset Managers. And I know you're smiling broadly right now because your deep value portfolio is yielding good returns. We're starting to see the performance shooting the lights out on this one, aren't we, Adrian?
Well, at last, yeah. It's, I think, it's well known that value has been off the front burner. 2008, 9, 10, not much was going on in terms of the recognition of value. And through much of 2011, it was that case. And really in the last 6 to 9 months, I think there has been far greater acceptance of the intrinsic value in
what do you
businesses.
think has caused that change in perception where people are starting to, is it because the other stocks have just become expensive? You know, we were talking about retailers early on. Am I interrupting again?
No. I love it when you take control of the interview. I'm going to hand over to you at this point.
We were talking early on the show about retailers becoming expensive. So is it a question that the fund manager thinks these stocks are expensive, let's go into some other stuff that we haven't looked at, and then he finds the stocks that you own and he buys those because they just seem cheap?
I think there's definitely an element of that. There's probably a couple of other factors that have contributed to it. The one being that global capital has been allocated essentially to the very top end of the domestic market. And it's unlikely that they go in search of these smaller, less known opportunities. So they've gone for much of the headline stuff. And our assessment has been that stocks that were fully priced have gone from fully priced to even more stretched. And that did a lot of the lifting in 9, 10, 11. And there's a point at which it essentially becomes just a bridge too far. And we think that that point was reached late last year. And as a result, capital has gone in search of what I think is true opportunity in this environment.
Can the Superdogs continue flying high?
Well, yeah, I think that as long as an investor has patience, the principles that sit behind it work again and again and again. There's nothing novel in terms of the principles. They're well established. The attribute that is hard to bring as an investor is patience. So when you're walking these hard yards through a couple of years and it just seems that the thing is exhausted, it's often at that point that people give up and they go and find whatever's the flavor of the day, whatever's doing well. And it's once it's turned on that people are then, wow, let's have a look at this, and they allocate their capital. So I think often investors tend to be reactive, and as long as they stay with the portfolio, they will continue to be rewarded. Now the term I'll use is through the cycle. I'm not quite sure how long through the cycle is, but I know that if you're with this for 5, 10, 15, 20 years, you're going to have a terminal portfolio that is substantially better than just about anything else you could have had.
Kevin, can I sneak one more question in? When we talk about good performance, give me some numbers. You can give us a little detail on this front.
Yeah, Bronwyn, we've been running this as a study since the mid-1990s, as you mentioned. Over that period, the market has returned, or the benchmark has returned 5 times initial capital. And this portfolio has done 18 times initial capital. It's done it with a little bit more than market volatility. So, if volatility is risk, which we don't agree with that assessment, but many people want as low a volatility as possible. I understand that, but the result is 3 times your market return over 15 years. With outside capital, the portfolio, as you mentioned, has been live for three years. And over that time, despite value being turned off, it's done 100% of initial capital, whilst the market has done about 90%. So it's ahead of market over the 3 years.
In terms of the stocks that we're going to talk about stocks in a moment, but in general, when you approach your stock selection, is it a question of just finding stocks that are relatively cheap, or are there other criteria you're trying to tick along the way in terms of the quality of the management and maybe the historical track record performance of the company?
Sure.
Are there any checks in place?
Absolutely. you'll appreciate that in terms of the historical study, we were far freer in terms of the types of companies that we put into the portfolio. We were able to be far more liberal. Using one of the core principles of deep value investing, though, that the one thing you can't recover from is permanent destruction of capital. If you put your capital into a company that looks compellingly priced, but it's actually a walking disaster, once that money's gone, no amount of subsequent investment brilliance will bring it back.
Can you give us such an example?
Well, I can give you a number of examples over the years. And if you think of the late 1990s and recent years, the mid-noughties, there were a couple of examples. Alliance Mining might be...
Where does Supergroup fall into this?
Well, Supergroup hasn't been... We haven't had capital allocated to Supergroup in recent years. There are a couple that we have definitely got wrong in recent years. I think the biggest one that we've got wrong was One Time Airlines, which looked really cheap at less than net asset value 2 years ago, and it's gone from less than net asset value to even less.
Have you cut your losses on that one?
We've walked away from that because, and the point that Kevin asked is, do we apply other principles? And absolutely. So being very sensitive to the risk of permanent destruction of capital. Once we went live with the portfolio, we became very rigorous in terms of stress testing balance sheets, forensic tests, understanding management quality and caliber in far greater detail than we were applying in the case of the essentially test portfolio. So I think it's fair to argue that we are very mindful of management depth, management quality, the nature of the business. This is not just a case of buying out of favor companies on very low multiples.
Now let's look at some of the stocks that currently sit within the Superdogs portfolio. Conduit, you've thrown forward to. I have to admit my ignorance on this one. I don't know anything about Conduit.
Yeah.
Kevin, do you?
No, I don't. I was going to add to that. I've got no idea.
So we're both very ignorant.
Okay. Well, maybe before I offend Jason Drone, the CEO, just to emphasize the point that our description of Superdogs
I do know Jason Drone, though. So there we are. We are now getting to the same page. Sorry to interrupt.
The attribute of these portfolios that we are investing in is the super caliber. The reason why we are investing is because of the dog's description, and the dog is not our assessment.
Just go back. What is super caliber?
Well, it's that these businesses, these are good businesses. They've got healthy balance sheets. They've got great potential. They've got good history, but perhaps have lost their way. They're building great businesses, but it's off the radar of the market for the moment, or because of the size of the company. But for some reason, the business is out of focus, off radar, and whilst they are great businesses, the dog description is what the market's assessment
it's like the
of
dogs
this
and
is.
diamonds. I mean,
Exactly.
we've got used to that terminology in
so
the
the dogs is not is not by any stretch our assessment of the company. In fact, we think that these are great businesses.
Because your dog wears a red cape.
Our dog wears a Superman cape.
Exactly.
So, Conduit, I think, is nice to talk about because they produced results, they released results yesterday for the first 6 months of the current financial year. They show earnings up 40%. They start the financial year having produced a good set of results that included paying a 10-cent dividend on a 70-cent share price. That was at the start of the year. That gives you a dividend yield of about 15% on your initial 70 cents. The price is subsequently lifted. It's trading mid-80s to about 90 cents at the moment, so the yield is a bit thinner. But you're still talking about a 12% dividend yield on a trailing basis. They don't declare interim dividend, so we must wait for the end of the year to see if we are rewarded again. I suspect we will be, because the company is very cash rich. They have a market cap of about 250 million, so it's tiny. It's it's off the radar of.
What do they do?
What do they do? I was going to ask you.
Well, sorry, I'll come to that in a moment. If I could just finish the point that whilst they have a market cap of 250 million, they've got about 200 million cash on their balance sheet. They delivered 40% gain in earnings, and the price-earnings ratio now is about 7 times, with a 12-13 dividend yield.
That sounds like a no-brainer from an investment
Net asset
perspective.
value is around a share. So what they do is they're essentially a financial services business. The hub of the company historically has been Constantia Insurance. That's the hub of the business historically, and in recent times they have moved to direct insurance and are building an in-house private equity portfolio, which includes amalgamated appliances. And that's been a real recovery story over the last 6 to 12 months. So you could see this as a financial services business that's offering insurance as its historical core, very profitable, good cash flow, strong balance sheet, which is what you want to see in an insurer, and they're using that strong attribute to put other tentacles into the financial services arena.
Let's touch on data Centrex. Recently, Gary Marolo leaving the studio. It must have been about 3 weeks ago. Am I right on that?
In terms of their results.
In terms of their results.
Weeks back.
This is in the IT space. We know that these smaller IT players have now taken center stage with the elimination of dimension data from the listed community. Why data Centrex out of the others?
Data Centrex has been in this portfolio for a long time. And
how long?
Well, we've been invested outside of Superdogs. We've been invested for data Centrex for about 6 years. So we've been with the company for a while. In Superdogs, it's been in the portfolio since inception, 3 years. I guess in some way it's been quite frustrating because their earnings haven't gone anywhere in the last 3 years. The market's become frustrated and they have, as a result, put a very attractive rating. The interesting attributes of this portfolio, of this company, despite the tough environment, they've defended earnings. So certainly they haven't grown earnings, but they've defended earnings. The earnings consistently convert to cash flow. So these are high quality earnings. Single-digit price earnings ratio, 6% dividend yield, a market cap of about 800 million. They've got 300 or 400 million cash on balance sheet. So these are the attributes that you will consistently see in the Superdogs companies. A very experienced management team, and this is a great business. Good prices, defensive attributes, and lots of upside when the recovery comes.
Is that upside government dependent?
Kevin, I think that that's an important element, and for that reason, Data Centrex is working actively on reinstating their empowerment position, which has been compromised by the loss of a partner. So they have to reinstate that, and I know that management is actively working on that.
What about AdCorp? This is an interesting one, because obviously that labour broking issue has one that has been looming, am I right?
Of course, of course.
You look at me as though I've said, I suddenly thought maybe I've got this completely wrong and
no.
I should look for another job.
Is that the way I looked at you?
Yes. Like, anyway, I'm glad I'm right. So
no,
it has been
you're absolutely
right.
You're absolutely right. And I think that that is a very obvious negative on sentiment, that just what is going to transpire here. Our assessment is that these businesses will find a healthy compromise with the legislators, that policy will essentially come to its senses, and that the draconian proposals that have been put on the table are likely to change. If they don't, then a business like AdCorp is at tremendous risk. So, I think any investor in this type of business has to appreciate the vulnerability.
Sorry to interrupt you, what would then happen? Let's say that the legislation turns out to be more onerous than what you're really expecting. You've held this company. Do you then make a sell decision in your fund?
Definitely. Then the facts have changed. The circumstances have changed. And what we recognize right now is this is a risk that the company is exposed to, but it's not a reality. If that transpires to a reality, of course, the price will be marked down. But that is, I think, one of the vulnerabilities of this investment. It's also what you are rewarded for when you assess it correctly.